enter the same retirement balance into two calculators, and one may tell you that you are safe, while the other says you could run out of money. Change the retirement date, expected return, inflation rate, or lifespan, and the answer moves again. A green score becomes yellow. 92% becomes 68%. Suddenly, a plan that looked finished needs 5 more years of work. That does not mean retirement calculators are useless. It means they are answering a narrower question than most people realize. To use them properly, separate 3 things: the facts you know, the guesses nobody knows, and the escape routes real people can use when life refuses to follow the spreadsheet. Start with the facts. A useful calculator begins with your actual life, not with a round number borrowed from an article. Your current account balance is a fact. Your current contribution is a fact. So are the pension estimate, social security estimate, mortgage balance, debt payments, and the amount your household spent over the last 12 months. Even these numbers need cleaning. A household may say it spends $60,000 a year, while quietly excluding home repairs, car replacements, gifts, travel, and the taxes that will still exist after the paycheck stops. Another household may assume retirement spending will equal 80% of salary, even though a large part of that salary currently goes towards saving, commuting, payroll taxes, and a mortgage that will soon end. The calculator cannot correct a life it has been shown incorrectly. Before adjusting investment returns by 0.5%, build a realistic retirement budget. Separate essential spending from flexible spending. Add irregular costs. Decide which debts will remain. Estimate healthcare and taxes separately instead of hiding them inside one vague number. Account location matters too. $1 million inside a traditional retirement account is not identical to $1 million in a Roth account or a taxable brokerage account. The balance may look the same, but the taxes, withdrawal rules, and amount available to spend can differ. Guaranteed income must also be entered correctly. A pension beginning at 65, Social Security beginning at 70, and a portfolio withdrawal beginning at 62 create 3 different stages. A calculator that treats all income as though it starts on the same day is modeling the wrong household. This one preparation step often changes the plan more than selecting a different calculator. Now come the guesses. Future market returns are guesses. Inflation is a guess. Tax rules 15 years from now are a guess. Lifespan, healthcare costs, home repairs, and the exact year a spouse stops working are guesses too. A calculator may use historical market periods. Another may run thousands of simulated market paths. Another may use lower forward-looking return assumptions. None of them has discovered the future. Each is testing a different version of it. Historical testing asks how the plan would have behaved through actual past periods. Monte Carlo analysis creates many possible sequences using a model of returns and inflation. Both can be useful, both can mislead when the user treats the result as a forecast rather than a stress test. That is why a result such as a 91.7% probability of success can look more certain than it is. The mathematics may be precise, the assumptions are not. A Monte Carlo calculator usually creates thousands of possible sequences for returns and inflation, then counts how many paths satisfy its definition of success. If 9,000 out of 10,000 modeled paths avoid depletion, the screen may show 90%, but that percentage belongs to the model you entered. Change the spending, time horizon, asset mix, return assumptions, taxes, or definition of failure, and you have asked a different question. The score is not the probability that your real life will work exactly as planned. It is the percentage of modeled lives that worked under those rules. Sequence matters as much as the average. Two retirees can earn the same average return over 30 years and have different outcomes because one suffers the losses near the beginning, while withdrawals are removing shares at depressed prices. A calculator that handles sequence risk differently can produce a very different answer without either calculator making an arithmetic mistake. That difference matters. The famous 4% rule is a good example. The basic idea begins with withdrawing 4% of the portfolio in the first retirement year, then increasing that dollar amount with inflation. The original research tested combinations of stocks, bonds, withdrawal rates, and historical payout periods that ranged from 15 to 30 years. A portfolio counted as successful if it survived the selected period without being exhausted. That is useful research. It is not a promise that 4% fits every retirement. A person retiring at 70 with a pension and a 30-year planning horizon is solving a different problem from someone retiring at 50 with no guaranteed income and a possible 45-year retirement. The rule also begins when retirement starts and the portfolio value is already known. It does not tell a 45-year-old exactly how large the portfolio will become 20 years later. Those are two separate uncertainties. First, what balance will you actually reach? Second, what spending will that balance support once withdrawals begin? Mixing those questions creates false confidence. Someone may calculate that $80,000 of spending requires $2 million under a 4% rule, then assume the current savings plan will reliably produce $2 million on the chosen date. The withdrawal rule did not prove that. It only converted a future balance into a starting spending estimate under a set of retirement assumptions. This is one reason different tools disagree. One is projecting the accumulation years. Another is testing retirement withdrawals. A more complete tool is trying to model both, which adds another layer of uncertainty before retirement even begins. Then there is the retirement length. A 30-year plan and a 50-year plan should not produce the same answer. The money in the longer plan has to survive more withdrawals, more inflation, more market cycles, and more chances for an expensive surprise. Current retirement income research may publish a starting withdrawal figure close to 4%, but the headline only makes sense beside its assumptions. For example, a figure of 3.9% can be based on a 30-year retirement, inflation-adjusted spending, a chosen asset mix, and a 90% target for funds remaining. Change the retirement to 40 years, require a larger inheritance, or demand almost no chance of depletion, and the recommended spending can fall. Change to flexible spending, add Social Security or a pension, or accept using more of the principal, and the household may support more. The percentage is not the plan. It is one result produced by the plan. Asset allocation creates another disagreement. A stock-heavy portfolio may create a higher average ending balance while also producing larger declines. A more balanced portfolio may show less upside but give the retiree a smoother experience. Two calculators can both be reasonable and still prefer different allocations because they value different outcomes. One may reward the largest median estate, another may focus on avoiding depletion. Another may penalize large short-term losses because a retiree may panic and sell. The best-looking ending balance is not automatically the best retirement. You have to live through the bad years inside the simulation. If a 40% decline would cause you to abandon the portfolio, then a model assuming you hold calmly through every crash is not modeling you. This brings us to the most misunderstood word on the screen: success. Success may mean ending the final year with at least $1. It may not mean maintaining the desired lifestyle, paying for long-term care, leaving an inheritance, or feeling calm during a severe market decline. A plan can technically succeed while requiring painful cuts for 10 years. Another can be labeled a failure because it ends with zero at age 100, even though it funded decades of retirement exactly as intended. Some tools also assume retirement ends at one fixed age for both spouses. A household may care more about protecting the surviving spouse, keeping the home, or funding care than about maximizing the combined ending balance. Those goals need to be stated before any score can be interpreted. Before trusting the score, ask what success means inside that calculator. Now for the part that matters more than another decimal point, the escape routes. Most models begin with a schedule and follow it mechanically. Real households adjust. They delay replacing a car. They reduce travel after a bad market year. They work 6 months longer. They claim Social Security at a different age. They downsize, earn part-time income, or stop increasing discretionary spending with inflation for a while. That flexibility has value. A rigid withdrawal rule assumes the same inflation-adjusted lifestyle regardless of market conditions. Dynamic spending allows modest increases after strong years and modest reductions after weak ones. The trade-off is less predictable annual spending, but the portfolio can respond to reality instead of pretending every year is identical. This does not mean cutting groceries whenever the market falls. Divide spending into 2 layers. Essential expenses need reliable income and stronger protection. Flexible expenses can absorb temporary changes. Housing, basic food, insurance, utilities, and medicine should not depend on a lucky stock market. Large trips, gifts, renovations, and optional purchases can move. The safest plan may not be the one with the highest simulated score. It may be the one with the most realistic adjustments that do not ruin the retirement. A household showing 85% with low fixed costs, delayed Social Security, and flexible travel may be more resilient than one showing 95% while requiring every assumption to remain perfect. Human behavior is another escape route and another risk. A plan that looks excellent only because it assumes you will rebalance during a crash, ignore frightening headlines, and cut spending immediately must be judged against what you and your spouse are actually willing to do. The strongest plan is often the one simple enough to follow when the market and the news are both ugly. So here is a practical way to use the calculators without getting trapped in the rabbit hole. Run 3 versions. The first is the base plan. Use reasonable spending, a realistic retirement date, current guaranteed income, and moderate assumptions rather than the most optimistic numbers available. The second is the bad decade plan. Reduce early returns, raise inflation, add a major home or healthcare expense, and test retirement during an ugly market sequence. The third is the flexible plan. See what happens if you work 1 year longer, reduce discretionary spending by 10% during weak markets, delay Social Security, or earn a modest amount part-time. Do not ask which version predicts the future. Ask which small decision protects the plan most. If 1 extra year of work changes everything, you have learned something useful. If cutting optional spending for 2 weak years repairs the result, the plan may be stronger than the headline score suggests. If every version fails unless returns are excellent, the problem is not the calculator. Review the plan regularly, but do not rebuild it every weekend. Update it when spending changes, income changes, retirement moves closer, or a major assumption becomes real. Retirement planning should reduce uncertainty enough to make decisions. It should not create an endless search for the one model that finally says what you want to hear. Know the facts. Use ranges for the guesses. Keep escape routes. In the comments, tell me which number changes your retirement result the most: spending, retirement age, returns, or Social Security. Next, we are stepping away from complicated simulations and looking at the most powerful retirement advantage of all: time. What do people approaching retirement wish younger workers understood before their first serious paycheck disappears? A calculator can test a plan. It cannot live the plan for you.